This is Ashish Shanker, Head Investments at Motilal Oswal Wealth Management. I'm happy to present to you the first of our series, Know Your Investment Gurus. We have somebody with us who spent about 3 decades in the capital markets in fixed income as well as in equities. He's impeccably qualified. He's a MBA from IIM Calcutta. He's a cost accountant and a rank holder in chart accountancy. He is extremely well read and I'm really happy to have him with us. His strategies have had a fantastic track record over the last 2 decades. He spent time at Birla Asset Management and now he spearheads the ASK Asset Management business. We have with us Mr. Bharat Shah. Bharat bhai, welcome to the show and I'm really glad to have you on this show today. So you've spent a long time in capital markets and you've involved a very clear investment philosophy over these years. So could you talk us through your journey as to, when you started, how markets were and how they are today, and what has really been your drivers in terms of, evolving a framework and philosophy?
Well, I think over last 3 decades in general and 2 decades in particular, there is a dramatic transformation of our markets from the kind of relatively primitive and callow kind of markets that we had. Our markets have become far more contemporary, far more sophisticated, far more mature. Secondly, if you see the behavior of the market in terms of transition to be able to distinguish between the good, the bad and the ugly, which wasn't always evident in the markets of the earlier times. But today you can very clearly see how markets beautifully distinguish between the good, the bad and the ugly. So if we see markets are at relatively the highest point in its in the history, but preponderant percentage of the companies within the market are probably 50% or even lower than their previous peak, and that speaks about the beauty of the markets. Third, I think noise level has increased. There is an attempt to overanalyze, over-understand, over-reflect short-term rather than really ponder and think deeper and longer term for the businesses. So noise, like in the society, has gone up. The noise in the markets also has assumed a very, very high proportion. Fourth, I would say markets have become much deeper and therefore markets are now difficult for any individual entity or entities to really influence unduly for any length of time. And I think that is pretty good news. Also, overall, I think our markets are regulated quite well, and therefore these markets reflect really the markets which will show the power of the emerging India in terms of the growth of the businesses, the quality of those businesses and the value creation by those high quality businesses. I think our markets are now ready to reflect that deep opportunity and potential in a beautiful way.
Right, right. I know that you've been the architect of the investment philosophy at ASK, and you have a very clear approach to stock picking and building portfolios. Could you talk us through this approach?
Well, I think primarily there are two important objectives of any investment undertaking. One is to preserve capital, and second is to grow, because it is not enough merely to preserve, but in that order, where preservation occupies a slightly more kind of a bias in the overall scheme of things, and appreciation over a period of time almost equally important, just slightly behind. I believe preservation really is a function of quality, quality of the management, quality of the business and the quality of the financial position. It also is a function of margin of safety, the price that you have paid compared to the value. But my experience shows that if you really have bought quality, then margin of safety may vary the amount of returns that you may make, but it is unlikely to expose you to the permanent loss of capital. So guarding against the permanent loss of capital or preservation really is emanating from the quality. Quality of management, to my mind, is probably the single most important factor. The governance and integrity, the vision and execution, capital allocation and capital distribution, all are telltale marker signs of a good management or otherwise.
Sir, on management of quality, are there any quantitative parameters that an investor can look towards, or is it more subjective where you have to meet the management and get a feel of?
Well, like Phil Fisher says, return on equity is a holy grail of a great management. So that is a quantitative measurement. But even the ones that I described in terms of the vision and execution, integrity and intensity of efforts, or capital allocation and capital distribution, are not all that intangible as they appear. If you really study the track record of the business over a period of time, how the management has dealt and behaved is something quite easy to quantify and kind of understand. We just need to have patience and need to go through meticulous study of that. The quality of business is almost equally critical, because even a great management needs a great business for it to create value. And therefore, an ability of a business to generate an outstanding and not just good return on capital employed, but that outstanding return on capital employed for a material length of time, well in excess of the cost of capital, is a very, very important benchmark of the quality of business, and which is comparable across different sectors, different businesses in a uniform way. Quality of financial position is something typically would emanate from the first two, but it still needs to be assured, and it should not be jeopardized by any misactions, even by a good management. Once these three things are complete, then you're confident that you can't have risk of a permanent loss of capital. Then I think the next task moves to the appreciation. The appreciation really is a function of the growth. Growth not just of the top line or the bottom line, but of the real cash flows over a period of time. And that would emanate from the two simple ideas, the size of opportunity and the competence of management to be able to extract from that size of opportunity into an outcome. Once these two are in place, then we see a growth over a period of time. It doesn't need to be a dazzling or an outstandingly large growth in a short period necessarily. What works equally beautifully and probably more is a solid growth, but replicated over a material length of time, predictable, reasonably easy to comprehend, and something which is going to have a durable compounding machine kind of a character. So these two put together would create economic value. An effort then is to buy that economic value at some discount, so that you make not only the underlying economic returns, but you will also make an extra by way of a discount from that economic value. So the once the quality of the growth is right, then the growth will give you the compounding returns, which is the underlying economic returns. And if you bought that package at a discount to what it is worth, that discount is a one-time extra and icing on the cake. So the cake will come from the underlying compounding, and the icing on the cake would come from that discount. And that margin of safety or a discount is really function of discipline of the manager, ability to value the business appropriately so that he knows what is a good price to buy or otherwise, and finally wisdom to stay the course. I think once we finish all of these, a large size of opportunity in the hands of a good management will result in a growth Growth coupled with a high quality of growth will create economic value. And economic value, both by a mature investor with patience, having judged the value well and held it over a period of time, will create investment returns superior to the economic returns. This, I think, is a fulcrum of what we seek to do. And in every business that we buy, these five traits we seek to include. The management quality, the size of opportunity, the business quality, the growth and the margin of safety.
I think that was wonderfully explained, sir. I find that a lot of investors spend time trying to, they spend a lot of time on the price of a particular stock, and they look at valuation parameters like P, etc. How do you view valuations?
I think P is one of the most deficient ways of judging value or trying to predict price. And unfortunately, it is so popular that it is almost assumed a monstrous kind of a proportion of certification from the market behavior, or rather behavior of the market participants. P can hardly be any meaningful measurement of a value. Price earning multiple essentially is price today and an earnings over a short period of time, maybe a year or two or whatever. While value of a business can't be about 1 or 2 years of earnings, but a lifetime of the value creation. Secondly, price earning multiple by definition seeks to just correlate price today with some earnings number, but it doesn't take into account the time value of money. And valuation parameter without time value of money is a complete financial illiteracy. Thirdly, price itself is influenced by fundamentals. Price at a point of time is a combination of fundamentals plus the noise or sentiments at that point of time. Therefore, price itself is influenced by externality, while the value of business is all about intrinsic to that business, and therefore there is a complete intellectual contradiction in terms of using an external parameter to judge the internality of a business. So there is a bit of a confusion. I think value of a business is nothing but what it is worth as far as tomorrow's profits are concerned, or cash flows. And those cash flows can't be for a short period over the economic life of the business. Those cash flows, since they occur over different periods of time, they need an appropriate discount to reflect the appropriate time value of money or the internal rate of return that you expect. And constant effort thereafter is to keep evaluating whether the assumptions that went behind judging the value remain valid, whether the size of opportunity judgment remains valid, management capability, and therefore the assumed growth rate. More importantly, the quality of the growth rate, therefore the cash flows, and not just the gross cash flows but the incremental cash flows. Also, given the constantly shifting sand in terms of the businesses and the disruptions, what is the relevant economic life of the business and how far it is valid. These issues constantly need a reflection, and therefore the value will be revised based on that. But value certainly cannot be simplistic factor like price earning multiple.
Right. So it's more important to know the value of the business rather than the price, and it cannot be looked at from a simple lens of one or two financial parameters.
Oh, without any doubt, I think the price is a servant, value is a master. But unfortunately, the way participants often behave, we tend to value the price rather than pricing the value, and therefore there is kind of a confusion which comes about. Ultimately, the beauty is that even if however violent is the difference between price and value at a point of time, over a period of time, like a magic wand, the two come together. And therefore, if you are a patient investor, you have judged the value well, you bought it at a discount to the value, you can be rest assured in a confidence that eventually price will equal the value. You will bridge that gap between price and value, or the margin of safety, as a one-time extra. plus the underlying growth, which will give you the compounding kind of returns. So the value only can really be the determinant of the long-term outcomes.
I've also heard you talk about size of opportunity, and I guess it is very closely linked to the growth in the business for the future. What is the relevance of size of opportunity to your investment framework?
Well, I think it's a fundamental mother factor. Size of opportunity is not really about the size today or yesterday. It is entirely about the potential to get bigger than what you are today. So it is not about the extent size, it is more about the potential to grow. And therefore, the critical aspect is not the size of the fish, it is the size of the pond. Pond has to be large. If the pond is large and with the right conditions, a capable fish, even if it is large, will get much larger. And if it is not so large, still will get much larger simply because the pond is big and the conditions are fertile and the fish is capable. So the debate about large cap and mid cap and small cap often are debates really about the size of the fish. But the real debate, to my mind, essentially has to be about the size of the pond, because that will determine tomorrow. And the size of the fish today is more about a reflection of past and present, while really the investing is more or less about judging the future, where past and present are only a very small minor part of the overall deal. Therefore, when people are getting carried away by the size of the fish, they are not really essentially reflecting about the future.
So focus on the size of the pond rather than the size of the fish.
Absolutely.
So with that, how do you see India over the next 7 years? Let's say from 2018 to 2025, how big is the size of opportunity, and where do you see the opportunity? What is your vision for India in 2025?
Well, I believe we are at a vantage point of an opportunity where probably the best period for Indian economy, hence some of the outstanding businesses, quality and transparent businesses within the fold of the economy, and hence their performance, their profits and cash flows, hence their economic value, and therefore their stock prices, and therefore that of the indices. I think we are standing at a vantage point of what I would say is a golden decade, if not more, of a phenomenal compounding ahead. When people are concerned and expressing a lot of concerns about various matters, sometimes it comes in form of oil, in trade war, it comes in form of FDA tightening the interest rates, or concern about domestic situation. People are essentially unduly focusing on concerns and forgetting to look at opportunities. And I'll prefer to look at opportunities rather than overly getting concerned by concerns. If you want to make it a business to get yourself concerned, markets provide you dozens of reasons every single day, and therefore it will take you away from good investing. But I think we are at a fantastic situation. Significant economic reforms have occurred, starting with demonetization. One of the biggest reforms that has occurred is GST, I think, which will fundamentally alter character of businesses, overall economy, therefore the government revenues. It will have salutary effect on bringing down logistics and other costs of the businesses and improve efficiency. And I think overall it sets the tone for a very modern India, modern economy in a very right way. Similarly, Real Estate Regulation Act or insolvency and bankruptcy process to even out the behavior of the promoters, as well as to rapidly resolve these thorny issues. Not to forget shell company closing down and the the work underway to resolve the banking difficulties that we have witnessed over some time. I think these, coupled with socio-economic changes of housing for everybody, or sanitation, and clean fuel for the households, plus infrastructure building, all of these are paving the way for a foundation of an economy where that's on a very strong footing. So I see some few major trends emanating from this. One is the shift from the physical to the financial. I think that is a very important change, from less liquid and relatively less economic value creating physical assets to the financial assets, which are more liquid and which have greater potential to create economic value of a higher order. Second is the formalization of the economy to make it transparent and more aligned with the modern way of the good economies, how they behave. Third, I think, is the probity that is being placed, the premium being placed by the markets on the probity and the governance of the businesses. And I think that is a huge, huge change which has occurred in the behavior of how markets are differentiating between the same rupee of profit made by two different businesses. Fourth, I think clearly the capital efficiency with all of these is beginning to inch up, and which is a telling effect on value creation. Simultaneously, the cost of capital is under control and has declined. And finally, I think variety of issues where costs will come down over a period of time, whether we take logistics cost, whether we take telecom and communication, even manpower cost is a percentage of sales has shown a tendency to dip. The cost of capital, even the relative capital intensity declining and capital efficiency rising, shows depreciation is a charge, as a percentage of the top line is diminishing. And finally, at some stage, with GST fully stabilized and the revenue collection going up, we will see moderation of the tax rate, both indirect as well as the direct ones, because the government finances will be in order. And therefore, I believe there are various levers for reduction of cost over a period of time. Therefore, there are fantastic opportunities. For example, finance as an opportunity is a huge, staggering
We are
opportunity.
almost going from, let's say, a 2.4, $2.5 trillion economy to a $5 trillion economy.
Oh, easily. We should be more than doubling the size of the real economy in these 7-8 years time frame. And therefore, it will mean that the finance businesses will grow at a rate much faster, because typically finance businesses display two characteristics. Their rate of growth of an economy in ascendance, which I believe India is in, is typically a multiple of the real GDP growth. And typically the finance sector growth precedes the growth of the economy rather than lags. And therefore, finance growth will be a lead engine of the growth of economy. And I believe we are slated to grow at meaningful 7.5–8%, if not higher, for a long period of time now. This stage is now set. Also the consumption, because this is an aspirational country. Even at relatively bottom of the pyramid, the consumption is not about cheapness, it is about value for money. So in terms of the consumption behavior, this country has displayed a great deal of discerning maturity over a period of time. And as the income levels rise, the rapidity of the consumption rise will be much, much higher. Because given the fact that our per capita income is about that $2,000, the magic number where we are currently, every improvement in the income level will relatively, in the middle and the bottom segment of the pyramid, will convert into consumption much, much higher. And therefore, that is a phenomenal another engine, which is a growth engine. Third is the trend of transparency, which makes formal and compliant business is in a far favored situation in variety of sectors that has been a trend, and therefore many businesses, whether you take jewelry as one example, even the consumer goods FMCG as a category itself is another example. There are clear winds blowing in favor of compliant and organized business units compared to the non-compliant and who do not want to mend and change their behavior. Therefore, these businesses will gain immensely, not only from the economy and the sector growth, but also the growth which they would take away from the non-compliant businesses in each of the sectors. Fourth, if you see long-term trends, for example, look at a business like insurance, where I think opportunity for growth could be not just a decade or more, but probably 2 decades and more. That is an area, it is driven by 3 essential factors. One, the size of opportunity is truly large in insurance as a category, both life and general. Secondly, the current penetration rates are pifflingly small at 2.5% and 3%.
It again relates to the size of opportunity.
Yes. So, both there is a huge size of opportunity, and secondly, penetration is itself low. Third, the size of opportunity itself is expanding with the growth in per capita income. And therefore, the 3 things put together sets a stage for a perfect, superb long-term compounding kind of an engine. So therefore, I would believe that insurance as a sector probably will grow in healthy double digit, not for 3 and 5 or 10 years, but probably 20 years and more. So outstanding compounding machines can be created in that area. Automobile is another area, for example, where clearly now India, from being a recipient of some products from outside and consuming it, has become one of the biggest auto hubs of the world. Whether you take 2-wheelers, you take 3-wheelers, you take 4-wheelers in commercial vehicle or a tractor or the cars, across the board, India has now developed the entire ecosystem around that area, from auto parts to the full automobile manufacturing, both for domestic consumption as well as for the international markets, of a fantastic variety. And I think this is something which is going to go further by leaps and bounds. And therefore, I mean, these are just some that I'm illustrating, but if I have to quote from Buffett, even after my 30 years of investing, I feel childlike excitement today. So to quote from Buffett, it's like you feel like a kid in a candy shop. That is the kind of opportunity I believe. So there is a fantastic transformational effect from the sheer growth of the economy, the growth of the per capita income, the rise of formalization and therefore shift towards transparent businesses and compliant businesses, rise of the discretionary consumption, and shift emanating in terms of growth of the income. Therefore, what will happen to the savings and therefore investment, need to manage those investments, need to channelize savings properly. So finance and investment is activity. Variety of the businesses, I think it is mouth-wateringly huge an opportunity. All we need to do is to find outstanding businesses run by great people, ensure that they have a meaningful opportunity, therefore that will have a meaningful growth rate for a meaningful length of time, and backed by capital efficiency so that all that growth creates economic value. And if we buy that economic value at some discount and patiently remain with them, then I think that's a recipe for fantastic value creation over a period of time.
Bharat, I think you summed it up perfectly. So basically, one should not focus on transient factors and the noise that we hear in the system, but be focused on the long-term wealth creation. We spend an inordinate amount of time in discussions around timing of markets and whether this is the right time to put in money, or should we wait, or should we stagger it. I just want to get your views on timing.
No, investing is not about timing the markets. Investing is not about predicting index level. It is not trying to be pundit about global macros, what will Fed do, what will happened to North Korean situation and the like. It is not even about over-analyzing Indian macros. It is really bottom-up stock picking of the good businesses growing at a meaningful rate, backed by quality managements, and you buying them at a sensible price in a disciplined way. That micro stock picking is an arduous hard work, and therefore people probably not prefer to do that. Macro form of investing is a lazy form of investing, and unfortunately it doesn't require precision, and therefore it becomes the preserve of a much larger dialogue. So that dialogue reflects in terms of timing the market, in terms of predicting index level, and trying to make profound quote unquote predictions about the macro situations. Because those macro grand clairvoyance doesn't require precision or any sense of getting it fructified in a meaningful length of time. And therefore, these are popular, but actually they distract you away from good investing. Good investing is all about long term. Long term not as a fetish, not as some artificial philosophy, but it is a fundamental route through which value is created. Because businesses are not designed in a fixed deposit way where there is a precise linear rise of a business in over a time period. They go through their spasms and changes, and that's part of the evolution of the businesses. Quality businesses ride through these cycles and eventually show what they are worth. So market behavior will go yo-yoing in ups and down kind of cycles, but good businesses also will have their cycles. But over a period of time, through that cycle, business will reflect that upward sloping curve, which gives a peace and calm. I think it is important to focus on that long-term value rather than noise, which is the short-term price.
More value in spending time on staying invested in quality businesses rather than trying to decide what is happening globally or what is happening in the micro.
And there is also attitude to be very smart alike, that every event we have to judge, every idea we have to kind of analyze to death. Everything has to be threadbare, kind of broken up into the constituents. Investing doesn't require an undue amount of micro petty analytics. It is really about getting the essence right, the direction right, the qualitative tenets right, and letting it free and soaring over a period of time, because good businesses eventually will do. You need to have a sense of value. It doesn't need to be some rocket science precise kind of a number, but you have to have a sense of broad value and the sense of broad destiny of the business. Once you have that sense right, that's what good investing is about. Instead, many times in very prosaic and at times artificial construct, we threadbare analyze every petty matter and try to make it look as if it is having a profound impact on the price, or by implication on the long term value of the business. But that rarely is the case, and therefore I think that in a way it offers opportunities, I suppose.
Bharat bhai, I know that you're very well read. Are there the top 3 or 4 recommendations for our investors to become better at the game? Which books would you recommend?
That's like kind of choosing in a harem of so many good ones whom to kind of
Or maybe
select.
5.
But I would say the book by Philip Fisher, Conservative Investors Sleep Well, as well as the Common Stocks and Uncommon Profits by him, are beautiful, outstanding books. Stocks for the Long Run by Jeremy Siegel, again an outstanding one. Security Analysis and The Intelligent Investor, Graham and Dodd, phenomenal groundwork in terms of the principles. So it may not We may not have to adapt many things which are topical and contextual at that point of time, but some of the essential principles are very valuable there. Also, the theory of value by Burr is a very, very good example of getting that conceptual foundation right. There are some, but there are plenty. But I think for good investing, it's not enough to read only good investment work. I think a larger overall reading which is balanced in over variety of important areas is vital. I think we may not be able to immediately correlate why reading reading a good book on science or physics or biology may be valuable, but there are important ideas when you read these work that you realize can be applied in some sense or the other to the world of investing. Also, the history has lot to tell about what are the things to be done and not to be done. And therefore, I think in some sense reading good history well documented over a period of time throws some powerful insights into human behavior. Study of psychology itself, because investing is fundamentals at one level plus the study of the psychology of the human behavior, which is a very important part, because the behavior of the markets or what is called crowd is really the psychology, and therefore reading that and understanding the psychology of the people is a very vital idea. So there are many branches of knowledge which it is difficult to immediately correlate, but they all combine together and to kind of lead you to a much well connected overall system of understanding investments well. I get reminded of that beautiful book called Lattice Work. Essentially kind of talks about how different branches of knowledge kind of all build into an integrated work. So I think investing is larger than just reading good investment books.
Bharat bhai, it's been a very interesting and enriching conversation for me, and I'm sure our investors will also be better off, after listening to this conversation. So thank you very much for this. Thank you very much for watching this episode of Know Your Investment Guru. It was a wonderful, interesting, and enriching conversation, and I'm sure you'll have a lot of takeaways. If you wish to participate in this great Indian opportunity over the next 7 years, we have a strategy which we've exclusively launched with ASK Investment Managers. It's called the ASK India 2025 Fund. We are always open to feedback. For feedback, you can write into us on our email ID, follow us on Twitter, or like us on Facebook. Thank you very much.